With conventional loans, you have a lot of flexibility around how your loan works. There are a variety of programs and options, and that's what makes them work for a lot of different circumstances. But unless you're paying 20% or more of the home's value up front, you're going to have mortgage insurance on the transaction. And with conventional loans, this can get a little complicated. So, mortgage insurance is a cost that's added onto your mortgage in almost all loans, where you pay less than 20%. We go into this concept in another video, which you should check out if you don't know what I mean. But with conventional loans, we're talking about private mortgage insurance. And that differs from the mortgage insurance for government loans by quite a bit. For one thing, conventional mortgage insurance falls off of the loan after the loan balance goes under 78%. If you're planning on living in your house for a while, that can be a big change in your monthly payments, even if it does take a few years to get there for most borrowers. The big thing conventional mortgage insurance does differently is how much its cost can vary. With government loans, all mortgage insurance costs are the same, no matter how much money you're putting down and no matter what your credit score is, as long as you qualify. Conventional mortgage insurance cares about both of those things. I think this will be easier to get with an illustration. LTV means loan to value, so if it's 97%, you made a 3% down payment, and if it's 90, you made a 10% down payment. At the top are credit score ranges, and then in the columns is the rate. Okay, so that's a bunch of numbers. How does that rate work? Well, every year that you're paying PMI, you will pay that rate times the original loan amount, and then that will be spread over 12 months. Let's do a few examples. Let's say you're buying a home. You have a 720 credit score, and you're borrowing $200,000 after making a 5% down payment. That makes our rate 0.64. So, how does this add to your monthly payment? Well, $200,000 times 0.64% is $1,280 annually, which means it adds $106 to your payment every month. But what if your credit was worse? Let's say 645. Well, with that new rate, your yearly cost comes to $2,560, which makes your monthly cost $213. For about 80 credit score points, you're paying twice as much a month. The other thing that affects those costs is your down payment. Let's say you have a lot saved up, but you still have that 645 credit score. Let's make a 15% down payment instead of a 5. Your loan amount will change because you paid more up front, but that also lowers that mortgage insurance rate a lot. So, at the 645 score, with that down payment, your yearly cost would be $767, which means it's only $63 a month. Okay, so that's a lot of math, I know. But this is why conventional loans are very dependent on how much you put down and how strong your credit score is. With these kinds of loans, it takes a good strategy to make sure you're getting the best loan for your situation, and your mortgage professional should be able to help you with that. Hopefully this video helps make it clearer to you why the different options you're presented with work the way they do. If you have any questions, please leave them in the comments below or email us directly. Please like and subscribe to make sure you keep up with our educational videos, even if they are a little nerdy math sometimes. Thanks for watching.